I'll give it one more minute for people to just trickle in. I know this is probably the last session of the day, so hopefully this won't take too long. Just as we get started, some administrative things. I have about 10-15 minutes of content that's prepared. And throughout the talk, if you have any questions, if you could start populating the Q&A so we can go through those, that would be helpful. And I'll try to do it in the order it comes in. Cool. All right, let's get started. We're 2 minutes in. So pleasure to meet everyone. Thanks for joining the call, how to create luck for yourself. Just to give you a little bit of introduction about myself, and my name is Daniel. I'm currently a founder of a tech company that's backed by an accelerator called Y Combinator. For those of you who are not familiar, they helped incubate companies like Airbnb, Coinbase, and Stripe, and some of the larger tech companies. Before that, I was an investor at SoftBank Vision Fund, primarily investing technology companies. And the idea of maximizing luck comes a lot from my learnings as a startup founder and as an investor. And I've done this talk a few times now. Something along this line with McGill University, which is where I graduated from, and then Seoul National University as well. So hopefully it'll be interesting for you. So the genesis of this talk really came from two things. The most important thing was every time I hear an interviewer ask the question to a very successful person in business and art and anything, they always mention luck. Oh, I got lucky. And everyone tends to talk about this luck. What I think is less discussed is that luck can actually be maximized and be quantified to some degree. And that's hopefully what I'm going to be talking about here. Just a quick caveat. So this is my session number 4 for today. The other 3 sessions I've written in-depth articles on Medium. So this was helpful. So for this one, this is just from scratch. So if you think of a stand-up comedy, this is point of view. This is me testing out a bunch of the content that I think is interesting. Okay, so in the talk, I'm going to quickly cover 3 things. The first is creating non-zero chances of asymmetric outcomes. The second is stacking those asymmetric odds. And then finally, the third is leveraging structure to maximize luck. So what do I mean by creating non-zero chances of asymmetric outcomes? Asymmetric outcomes, as I define it, is an option value or a choice where there is an unlimited, almost an uncapped upside to what you're doing, and then a floored downside, which is clearly defined. An example of this is venture capital, right? So when you invest, let's say you have $100 and you invest $1 into a company, that dollar is your floored downside. Even if the company goes to zero, you don't lose any more than $1 as an investor, right? But as you've seen with startups, they can actually 10x, 100x, even 1,000x the money. The most recent example is something like the Figma acquisition from Adobe. Figma 10 years ago was worth $10 million. Today, it's worth $20 billion. So it 2,000x'd in terms of value, right? So imagine being the first check into Figma. So this is what I mean when I talk about asymmetric odds. Same thing about being a startup founder or a musician or many of these things. You can become really big if it works out. So the other component of this is this needs to be non-zero. So what I see a lot of people do, unfortunately, is they have their day jobs or they do something day in and day out where the upside is absolutely capped all the time. There is no upside beyond what you're able to see. Obvious one is joining a particular company that's very structured, right? So you have to put in your 2 years or 3 years to get this. And then you have to go get your grad degree or an MBA for 2 years. And then you have to come back. And then you have to do another 3 years of this before the promotion. So it's really hard to deviate from that base. And there is no upside really beyond that. And if you're happy with that base case, that's absolutely fine. But I think the way you expose yourself is to maximize your luck is you go and try to find these asymmetric things and try to apply that for you. I mean, writing can be one example. That was one example for me. Starting a company was another example for me. So it can be as small as doing writing on the side, which I do. I only write once a month. And doing a startup, which is a career decision of saying, I know what my downside is, and that's my opportunity cost. And the upside is really, really big. I'm going to apply this to just to take a concrete example in the world of startups. So for a startup to happen, you have about a 2% chance of fundraising money from venture capitalists. For those of you who are not familiar, venture capital funds startup to kind of grow their company. So as a startup founder who has maybe a little, like a small product, this is a really good upside because basically someone is paying you money to go build what you want and then go share that success with you, right? And you're not using your money for it. You're not putting the 100, 200, 300 or $1 million into your business. You're sharing that risk with the investor to like really go big. The probability of that happening is 2%, but you get that probability only if you start a company and only if you start talking to investors, right? If you don't place yourself that's out there, this is a 0% chance of that ever happening. So this is what I mean when I say try to create non-zero chance of asymmetric outcomes. That's point number one. Point number two is like you want to start then stacking these. So let's say it's a 2% probability of like getting this, and what you typically want to do is if it's so low, you want to try to get to that 2% as much as you can and like stack a little bit. So if a single investor meeting, I'll flip that around. As an investor, as a venture capital investor, for every 100 meetings that I do, maybe I'll make one investment. That's typically a good sample size to think about it. So if that's the case, I have a 1% chance of being in that 1 out of 100. So the easiest thing I can do as a startup founder is stacking those. And that's kind of what I did for my pre-seed round, where I met with I had 160 different investor meetings, right? And each of those meetings, I had a 1% chance of getting that cash from just a pure statistical point of view. So not only did I create a non-zero asymmetric outcome opportunity by starting a company and trying to raise money from investor, by stacking 160 of them, I was able to at least somewhat linearly increase the chance of me getting in that 1 or 2% of making that percentages, right? This can apply to your career, I think, in an equal way. So again, you don't have to throw away your 9 to 5 or your day job to go do this. It can be small, like writing once a week, or playing around with a startup idea, or uploading that TikTok video. Whatever the case may be, where the upside is not artificially capped by someone else or by some organization, right? That's kind of like what you want to do. In less variant version of this is obviously like investing in things, right? People invest because there's a good upside, but the downside, ideally, as long as you're not playing around with shorts and like selling options, is like the amount that you invest in, right? So I think that's probably the closest version and the most accessible version that people think about. The last point that I'm going to talk about is structuring your probability of luck. And I think there are 3 tactical things that you can do. I'll apply it to like a startup first, and then maybe like how it can apply to your life as you think about your career decisions. So the first of the 3 is like creating inherent value. The second is iterating, and the third is structuring. So when I go into these fundraising meetings where I have like 1 in 100 shot of getting their money to go work on my company, ideally what I want to do is actually have a company that works. Right? If I happen to have a product that works and people like and people are buying, then having that inherent value just increases my luck by that much, right? So I'm not just playing around with statistics and probability anymore. I'm saying, well, like I know that investors are looking for these things. Let's just actually try to be valuable. The second tactical thing is mass iteration. So every meeting that I have, what I ended up doing was I had an FAQ of all of the questions that the investors asked me, and all of the concerns that I think they had. And I really tried to get to an answer of like, is it a yes or a no? And if it's a no, like why? And I tried to do that on the call because after the call, no one's going to give me the time. And based on that, I would iterate my pitch, the way I deliver it, right? So the way you deliver that method is going to be different. That's like number 2 of like structuring yourself to kind of maximize that luck. The final thing is very much specific to the industry or the thing that you're working on. I'll take an example of a startup again in this fundraising exercise. So we know that intuitively, if you and I try to buy and sell something, if I try to sell you this cup, and if it's just between you and me, the chances of me getting the highest price is actually not very high, right? We know that when we compare that to an auction, let's say I had everybody on this call start bidding for this cup. the probability of me getting the highest priced by running an auction versus trying to like work with each and every one of you on an individual basis is probably like much higher, right? So we know that's a structure that works. So I applied that to my startup fundraising, where instead of doing a one by one, hey investor, here's my company, will you invest? I ran an auction process and almost essentially created a market for myself. And this is the classic advice you'd receive from a lot of accelerators like Y Combinator and any founders who's gone through a early stage fundraise, right? And this is why I had 160 investor kind of squished into a period of, say 4 to 6 weeks. And what I would do is go hit up everyone and build that momentum and say, well, like and try to get like the price from all of the investors and try to get to a good, reasonable valuation and close the round as quickly as I can and get the money I need to go run my startup, right? So by doing that, I've also like exponentially increased the chances of me being able to raise, right? So I think this applies to like structurally changing things and applying things that work to this, to a bunch of asymmetric outcomes you already have placed in your life is probably good. Another quick example I give is like maybe like music. So instead of just releasing your music, having a release schedule probably structurally increases your chance of hitting virality when you release music, right? So there's little things that you can try to do and structurally improve the luck that you can have to go do this thing. And yeah, so I'll like quickly sort of wrap up sort of the things that I talked about. The first is, try to create a non-zero chance of asymmetric outcomes in your life. The second is try to like stack as many of those as possible as your time and resources allow. And the final thing is, for each of those things that you're working on, try to like optimize it and structurally change it so you have an unfair advantage of getting that luck popping to do this. And I think it can be applied to not just like your career, but everything else. Like maybe you've always wanted to be an actor, like go to that audition, right? Going to that audition puts you in a non-zero chance of that asymmetric outcome, right? Or like write that book or publish that post, or like it could even be for a romantic partner, like purchase that flight, go see that person, and hopefully you create that asymmetric odds. You stack enough of them in your life, and you only need like 1, 2, maybe 3 of these to pop in your life, like in your lifetime, for you to have an extraordinarily successful career. So I think that's all of the content that I had prepared. I think I'm at 14 minutes. I'll open up to any questions in the Q&A or the chat. So feel free to ask any questions. I know it's late, so if we need to kind of wrap up early, I'm happy to do that as well. So I'll give it a minute or two for maybe the Q&A and the chat, and then we'll see what happens. Oh, thank you. I guess I have someone from my previous talk. Thanks for joining. Hopefully this was helpful. Also, there's an ability for me to like invite people to, it looks like. I'm not sure how this works. Okay, I'm gonna wait for maybe like another minute or two for any Q&A to just come on in, and if there are no Q&A, we can wrap up the condition here. Share a story of your most difficult pitch. So I would say my pre-seed. So I raised a pre-seed round and a seed round. So just to timeline this, if it's helpful, is started my company in March of 2021, raised my pre-seed in April, got into Y Combinator in June, and then I raised my seed in September, October. So the hardest pitch for me was like the very beginning. I received all of the rejections, like 158 rejections, right? Only 2 of the institutionals said yes. And the reason it was so hard was I had a deck. That's all I had. I had an idea, and then I had a PowerPoint presentation. That was it. That was what I raised on. So I had to basically work out every possible scenario and question that people could think about to satisfy the investors and have them take a bet on me. Ideally, you already have like a product at least to get started with and show some traction, some validation, and it'll make it a lot easier. And in fact, if I were to do it again, that's exactly what I would do. Like trying to raise on just an idea is probably challenge. It's like not only hard, but like I don't think it's actually very good for you. Now, because now you have the investor pressure to go and like perform, but like you still haven't validated the idea yet. You're still validating that one idea, which may or may not work, and then you have to continue validating new ideas. How can an outsider come in touch with those circle of investors? I'm from a French Caribbean. So yeah, it helped that I come from an investment background. So a lot of my friends were in the investment space. A lot of my network was there. One of the things that Y Combinator and many accelerators like Techstar, 500 Startups, Antler, EF, there's like endless accelerators these days. One of the problems that they try to solve is precisely the problem I think, Olivier, you're having, where what if you just don't have like the network? If you get into one of these accelerate programs, their big piece is to connect you with a lot of US, European, or local investors who are looking at startups, even if you have a zero way of scratch, like getting in. And I think this applies for not just startups, like everywhere else. Like you have to put in the work to break in, whether it's music or being a creator. Like you just have to put yourself out there. In terms of like the impact of intros and how to get to investors, the most powerful introduction is going to come from their portfolio company. So what that means is, let's say I'm a venture capitalist and I invested in company Bravo. And the most powerful introduction is the CEO of Bravo reaching out to me and saying, hey, like, I know this founder, they're starting a company, you should take a look at them. That's the most powerful. The second most powerful is from my like network of investors or other people saying, hey, this is a cool deal or a cool thing that I found, you should take a look. And then the last piece is like you cold reaching out to them, which still, by the way, works from time to time. You can be creative about this stuff. I know some people who try to get introductions via Venmo by paying like someone $1 or like a cent and saying, can we chat? That's a thing that happens. Another question that we have is, how do you keep going despite all the rejections? How do you stay motivated yourself and stay positive despite a lot of no's? Yeah. Getting no's is really so I thought I was very accustomed to getting rejection. So throughout college, because of my financial situation, I applied to over 120 scholarships. So even at the end of college, I was like very used to rejections and like trying for this thing. With startups, it's even harder because at an early stage startup, it is not an exaggeration to say you are the startup. In fact, investors in early stage will say, who are the founders? What is the market? And like, what's the idea? These are like the three variables, and you happen to be probably the top variable. So when you're pitching your startup, you're pitching yourself, and when they reject you, it feels like they're rejecting you personally. I don't think there's any way around this. I know like many founders who just had a lot of like mental distress and things like this. I would try to keep a threshold of what you're okay with and not go beyond that threshold. For example, when I was doing my round, I was having anywhere from 6 to 12 investor calls per day, right? So my entire calendar was full with call after call after call. And what ends up happening is you end up getting 2 to 3 rejections a day, right? From these investors as like you continue your weeks on. If you can't handle that, like don't do that to yourself. Like don't make yourself extremely miserable. Yeah, in terms of motivating myself, like if you think the company is going to work, then I don't really see a problem of motivation. Like if you think this is going to be $1 billion company, like I don't think, a couple hundred no's from investors are going to like put you off. But if you don't believe that this is going to be a big company, that's when you start giving up and you don't see a path forward. That's when you start giving up. So hopefully you can get to a conviction in your idea and company and enough to withstand that 100 or so or 200 rejections that you'll probably receive in your first round of fundraising, if not more. I have another question from Karen. Hopefully I'm pronouncing that right. Where do you think your drive comes from? Wow, I had no idea this was a question I was gonna get. Where does my drive come from? I think there's a lot I want to do, and I'm generally a pretty curious person. Like again, I started writing on Medium on the side, just to kind of like put myself out there and see what happens. It's turned out like moderately okay. I think I did another chat on like so I generated about $1,800 of income just from Medium writing. like how to kind of continue to grow that. I think just wanting to try many different things and not wanting to be bad at it is probably like the big piece. Um, yeah, beyond that, I'm not sure like if there's anything else to say. I think everyone has a different thing. Are you the first in your family to do this sort of thing, or are you getting help from your family? So I have the opposite thing. So I'm the first person in my family to do this. I actually have to support my family financially, which took me a long time, which is why it took me a long time to start my company, right? So um, basically, like I not only had to create enough cash balance for myself, but also to support my family to get started. Some people have like families that can financially support, and that's fine. But for me, like it was mostly emotional support from my family, which is helpful. Like none of them said you should never be a founder. Um, that being said, I'd already sort of like um, proven myself with my career trajectory, at least in the aspect of career that I have a good sense of what I'm doing. Sorry, yeah, the family. I mean, like my parents. Like I'm not married, so like my parents and my sibling. How do you, from Mark, how do you protect your ideas through this process? Okay, hopefully by idea you mean like how do you protect your ideas and no one steals your idea? Is that right, Mark? I'm gonna assume that's what you're asking. If not, please. Okay. So having been on both sides of the table, like I try to be careful with this. No investor is going to sign a NDA, which is a non-disclosure agreement, which sometimes like founders ask for, usually in the early stages. It's usually at the idea stage that people ask for it. I'll give you my take. Hopefully it's not offensive. No one's going to sign that because like as a VC, and I'm looking at your industry, I've seen your idea probably 3 times in the last week, right? Like usually the ideas are not unique. Like Uber was not a unique idea. We already know this. We know that like all of these like crazy large startups, they were not revolutionary, innovative ideas that only they had. They didn't win because they had the idea. They won because they executed well. And like personally, like I know that these ideas, some founders think it's the only one. I've seen 3 or 4 of its variation in the last like in probably the week that I was like studying the market, right? So the idea typically isn't unique. The other temptation that I think early stage founders, myself included, fall into is overvaluing the idea. Typically, your first idea is never a good idea. There's very few founders who had a perfect conception of like what their company will be and then made that into their company. It's usually just a good starting point to test things out and iterate. And the iteration process might be how you pitch the product. It might be a different user base. It might be a specific use case within a different user base, whatever the case may be. So I wouldn't be super worried about investors sharing your idea or stealing your idea. That being said, there are a couple of red flags. One is if you are by a group of people who have the money just looking for a good idea to execute themselves, it might not be the best thing to sort of share the idea. The other thing is if there is a VC with a reputation, for example, for taking other startup ideas and like applying it somewhere else, you might want to be a bit careful. But even then, the counter argument to that is if you can't out execute these guys, then are you the right person to be building this in the first place? Which kind of begs the question of founder market fit. So that's my general view. Like no investor is going to sign your NDA. Because you look too young to have learned a significant amount investing in. What is your educational background? Okay, I'm happy to share like my professional background. So I did my undergrad at McGill University. It's a college in Canada. Then I started off in my career in management consulting for about 2 years at a firm called Oliver Wyman and the Boston Consulting Group. Spent about 2 years there. Left that and spent about 2 years at SoftBank Vision Fund as an investor. I started in the we used to have the office in San Carlos, so that's where I started. Then moved to the headquarters in London, UK, for about a year and a half. There, I did about 3 major deals and deployed about $500 million of capital. And then one of my portfolio companies, where I was a formal board observer, is now a publicly traded company. And I helped them raise about $300 million in debt and another $250 of equity before they went public in their IPO. That's when I left. I spent a year at the University of Oxford in doing my master's of policy degree, which is something I was interested in. And that's when I started Flobo. And then for about I've been running this for about 2 years now, doing that. And then and then from the investment side, I'm a venture partner at a fund called the Pioneer Fund that specifically invests in X, Y Combinator founders. So that's my professional background. Obviously, like I'm very young, I'm still learning, but I'm trying to share my personal experiences and the findings that I've had, and hopefully the best case scenario, like I continue to iterate on my framework on how to generate luck and how to make career decisions and whatnot. Cool. I think, all right, we're at, I see one more question from Simret. I have a very specific niche based on, I'll approve this. Wellness, spiritual and wellness world. I'd like to know how best to approach investors. Do I need to have a product or can be a range of services? So if you're going to, when it comes to venture capital, I think I briefly covered this. It needs to be really big. So venture capital companies are really banking on this asymmetric odds where they expect the investment to 100x, 200x, or even like 1000x. And then the other ones, and this one or two successful ones will pay for everything else and they'll make money. That's the math that they're doing. So when they invest in you, they need to have some belief that your company could be 100x or 1000x. So if it's a service-based business that scales with people, that's going to be pretty challenging to get to. Like if you look at some of the largest service-based, like people-based companies, like it took them a very long time to get there. So VCs need you to grow very quickly and to a very big number. So this is why most of VC money goes to technology, because technology scaling is very quickly and has no restraints and no marginal cost. So hopefully that helps you understand that. All right, I think that's about it. If there's any other, I think that's about all of the questions that I got in the chat. Appreciate you guys with engagement and staying on. I know this is the last session of the day, so I must have been tired. So thank you so much. You can feel free to reach out. I think my personal website is here. I think my Medium is here. So feel free to reach out on everything, and hope you have a good rest of the day. Thanks, everyone.